Hey there, everybody. Thomas Wood with Basecamp Trading. It is Friday, May 12th, and we're going to take a look at one of the setups that we had today in the trading room. That was a short setup in crude oil. Now, we had several different trade opportunities. We had the breakout in bonds. We had the breakout in the euro. We had pairs trades that were closing from yesterday and initiating today. We had the close, and we had the crude oil trade I'm about to show you here as well. But what happened with crude oil is this is continuing along the lines of price action trading, going back to those fundamentals of reading a price chart and identifying setups from the price chart itself. And the way this setup worked is first we identify trend. Number one thing we always do is identify trend. So we had a high here, a lower high, and a lower low. All right. So going 1, 2, 3, 4. So that means we're in a downtrend because we have lower highs, lower lows. If you don't understand the definition of a trend, I'm going to link to a video that you can go watch that'll teach you all about how to identify a trend based on price action for any market and any time frame. Okay, but we're in a downtrend, and then we had this short-term series of a higher low and a higher high right here. Okay, so we put in a high, a higher low, and a higher high. What we do is we draw what we call the line in the sand across those pivot lows. And if that line in the sand is broken, then we look for an acceleration to resume the underlying trend. So the underlying trend was down. We draw our line of sand on the micro trend. We break that trend line. The way you trade that, you enter on the break or 2 to 3 ticks below the break. So you'd be selling right around 47.72. Your stop goes above previous bar's high. So your stop would be about 47.80. So you have about an 8 tick stop. And you look for it to run. And as you continue to put in lower high pivots, you trail your stop down behind it. And that means you would have carried it all the way down. And then right here, we ended up having a bullish divergence. And a bullish divergence occurs when you have 2 pivot lows that are equally low. And you look at your momentum, and you have a significant difference in momentum. So see how momentum is significantly stronger here, even though price action is weaker? So that tells you it's time to close your short. That means you would have been getting out right around 47.47, 47.48. So not a bad trade. You're talking about 22, 23 ticks with 9 ticks risk. So really good reward risk. Really good trade. Then along the same lines of bullish divergence, here's the second bullish divergence that occurred right here. Pivot low number 1, pivot low number 2. Significant difference between the 2 pivots or momentum, strength momentum, and it turned around and started climbing back up. But either way, my whole point about this is even if you don't have any of the fancy indicators that you're seeing here, it's easy to identify setups based on just the price action. And that's what we call naked trading. It's getting your price charts back down to being just a price chart and reading the way the market is moving. If you want to learn more about that, there's going to be a link at the end of the video. You can go watch an entire webinar talking about naked trading. Also, don't forget to click the link in the bottom right hand corner to subscribe. If you want to try out the trading room, see what we're talking about here, see how we're finding these setups as the day is moving, you can join us in the trading room for an entire month for only $7. Okay, just in the description, there's a link for the $7 trial. So go there, you can get that. Join us on Monday. So have a great weekend. That's it for today. And until next time, happy trading.